Fed left rates unchanged in June, but communicated a dovish message, which teased up a rate cut as early as its next meeting in July. Now, the committee dropped the word patient in their statement, downgraded the characterization of economic activity from solid to moderate, and also revealed a dot plot which showed that 8 FOMC participants expect to cut rates this year. Our base case is that the Fed will cut rates in the second half of this year, although the timing and magnitude of the first cut will depend on US-Chinese trade tensions and how the global economic outlook continues to evolve. Together with the dovish ECB pivot in June, who indicated that more rate cuts and asset purchases will be forthcoming if inflation doesn't progress towards a symmetric 2% target, we see an explicit bias towards accommodative action from both major central banks. Now, central bank accommodation will be kicking in against a backdrop of slow but decent enough growth, and history tells us this scenario tends to be supportive of risk assets over the near to medium term if recessionary pressures do not emerge, which is our baseline scenario. Now, this is a positive setup for dollar-sensitive EM assets as well as high-yield bonds, which will benefit from lower rates, a more supportive environment for growth, and also provide sought-after carry in a reach-for-yield environment. Within high-yield bonds, we prefer Asian high-yield, particularly Chinese property developers, which offer better value than their Latin American and CMEN counterparts. In our view, Chinese property developers represent relatively appealing risk-reward at this juncture, which is underpinned by sustainable domestic demand, stable credit fundamentals, and manageable liquidity.